Hello, everyone. My name is Murat Yılmaz, and I'm the General Manager at Steel Orbis. I am delighted to welcome you all on behalf of the Steel Orbis team to the Steel Orbis 12th Annual Rebar and Wire Rod Conference. Even though we have observed a lot of improvements in many parts of the world still faces the unprecedented challenge of COVID-19. Travel restrictions and other factors continue to limit the movement of a lot of people. Under the current circumstances, we have decided to hold our 12th annual Rebar and Wire Rod Conference as a virtual event to ensure the health and well-being of all participants. I sincerely hope all the measures taken worldwide and the vaccines will help end this unprecedented situation so that we will be able to come together face-to-face as soon as possible. At Steel Orbis, we have been hosting several online events for the last few years. Amid the unprecedented circumstances brought about by the COVID-19 virus, the number of online events we have hosted has increased significantly. This event will not only be about a panel session, just like our previous online events, but it also provides you with online networking opportunities. Please allow me to quickly walk you through the online tools provided. You are now looking at the online platform of the virtual event, where you will be able to find everything you need. The online networking tools provided have been made available on the website since June the 4th and will remain open until midnight tomorrow. You may see who is attending under the Attendees tab and check their profiles. You can send online face-to-face meeting requests to participants for the conference day. In order to do that, just press Meet button on the participant's image and choose the time slot that you would like to meet with that particular participant. You may chat with online participants and also send messages to attendees, even if they are not online at that point of time. When you are chatting with a participant and decide to meet instantly without sending any meeting requests, you can visit the networking lounge. You may notice the lounge tab on the website menu. Just click and sit at the table and invite that participant to join you. The meeting will start automatically. If you want to get together as a group, that's also possible. Go ahead and grab a seat at the type of table that you need from a choice of virtual tables with multiple seats and start an instant face-to-face meeting. After the event, you will be receiving a short survey in the form of an email in a couple of days' time. We would greatly appreciate if you could spend a minute or two to answer the questions to help us improve our service. Thank you very much in advance. So, ladies and gentlemen, today you will have the opportunity to listen to two distinguished speakers and gain a better understanding of the rebar and wire rod market. We are going to have two polls to better understand your opinion. Let me go to the program slide. As I said, we are going to have two polls to understand your opinion. You may join those polls through the poll box on the right-hand side of your screens. We will also be running a live Q&A session at the end of the panel discussion. You may find the Q&A feature on the right-hand side of your screens too, and type your questions at any time you wish. If you, before I forget, if you wish your question to be directed to the speaker anonymously, please make sure to pick that option to let us know. I would like to thank you all for your participation at this event. We had over 300 registrations up until an hour ago for this particular meeting, and registrations keep coming in. I also would like to express my sincere appreciation to our distinguished speakers who will be using their expertise to inform and enlighten us today. Now, I will hand it over to my colleague, Katie Memel, who will be moderating today's session. Hope to see you all in person soon. Bye.
Good morning, everybody. We're going to start off with the poll. You can go ahead and we'll start the poll, the first one. As you can see, the first question that we have up is, if Section 232 tariffs were revoked, the effect on the domestic steel market would be. You can choose your answer. The first answer is delayed for a few months as exporters return to the market. Second answer, immediate due to the psychological effect of imports being on the way, or subdued as many in the US have adjusted their business away from imports. So you can go ahead and make your choices. We'll see what the results are in a few seconds. Give a few more seconds for everybody to answer. Okay. A lot of response still coming in. I'll give a few more seconds. Okay, let's go ahead and end the poll real quick. We'll have another one. So the results are 40% think that the effect would be a delayed effect, 35% think it would be subdued, and 25% think it will be an immediate psychological effect. So it's interesting. Okay, we're going to go ahead and get to our questions with our speakers, Mr. Bell and Mr. Casey. So I'd like to introduce them, Philip Bell, the president of the SMA, and Chris Casey, executive director of the Independent Steel Alliance. You guys can both turn your videos on so everyone can see you. Good morning, Chris. Good morning, Philip. How are you guys doing?
Good morning. Hey there.
Good morning. Good morning, everyone.
Okay, let's get into our questions. Some questions will be directed to either one of you, some to both. You can definitely respond to someone else's question, and I might have follow-up questions too. So the first question I'd like to ask, directed to both of you, domestic steel prices in the US have surged in the last year, with some products tripling in price since last summer. However, rebar and wire rod followed a much more modest upward trend. Prices are kind of rising now, but for the most part, it was a much more subdued reaction from the rebar and wire rod side of the steel market. Why do you think that was? We'll start, if either one wants to answer first. Chris?
Phil, you want to start?
Okay, sure thing, Chris, thanks. And once again, Katie, thanks for the opportunity to share ideas at the conference this year, and it's good to be with my colleague, Chris. I really appreciate you asking this question because I think it's important to distinguish between various steel product lines because each has its own market dynamics. And rebar prices are much lower than hot roll prices. And I think that's due to several reasons. I think it's important to note that when you look at the construction market, you really have a mixed bag. A lot of the construction projects that went forward in 2020 in the midst of COVID were projects that were already approved and already funded. But now over the last 6 to 9 months, what you're seeing is a construction market where if you are building warehouses, distribution centers, or involved in residential construction, it's pretty good. But if you're building retail or office space, or even publicly funded construction projects, not so good. So you have those dynamics at play. Also, in the specific case of flat roll, we've seen a tremendous amount of flat roll capacity being taken offline or idle, estimated between 4 to 5 million tons. So I think that has a lot to do with it.
Yeah, sure. Again, just like Phil said, thank you guys for having me today. I appreciate the opportunity to speak. And hi, Phil. Hope you're doing well.
Hey there.
This idea of why hasn't rebar and wire rod prices matched the run-ups in some of the other categories, I think Phil's right to a large extent that, that there are very different categories. I mean, you see certainly a couple of possible explanations here. I mean, rebar and wire rod relative to a lot of other products are relatively low margin from a producer's perspective. So it's an extremely rational decision to understand that a mill with limited, fixed capacity will allocate its capacity to products where it can make more money. That's perfectly acceptable, perfectly rational. So then you get into a situation of a little bit lower supply. And then when you do have some demand, whether it's artificially surged or just normal surging, but you've got higher demand, lower supply, bing, there's the recipe for higher prices. But then there's that question of, well, why hasn't rebar and wire rod kind of matched up to that with what other categories have seen? I mean, year over year, rebar's up about 55% roughly, according to most charts, against the shredded scrap gains of about 76%. And I say only 76%, but that still sounds like a lot. But I think what happened, at least in the rebar side, was years and years ago, most of the domestic mills started tying the price of rebar to the price of scrap. They wanted to find an objective sort of public index that they could rely on to sort of benchmark their price. But more recently, we're seeing the mills trying to decouple that. They're trying to sort of take a more subjective approach, tying it to just supply and demand. And so that sort of hints at, to me, the more obvious explanation for why rebar and wire rod hasn't necessarily matched the price run-ups in some of the other categories, and that's just pure and simple market competition. Even with constrained supply and even with the consolidation that we saw in the production of rebar and wire rod to some extent, the producers and ultimately the consumers, in my case, the fabricators, they still have to compete for how they're going to sell their steel. And unfortunately, as we always know, all it takes is one rogue actor to get hungry enough to say, well, I really want that job, and they'll drop their price. And that unfortunately sets the low bar for the market. And in rebar, I think the interesting dynamic that's changed a little bit is that we used to always talk about the dynamic between the independent fabricators relative to the mill-owned fabricators. And it used to be the independents were the ones that had to scrap and fight amongst themselves and then have to fight with the mill fabs. But with the consolidation that occurred a couple of years ago, I think now there's another dynamic at play, which is not just the independents versus the mill fabs, but rather it's the two mill fabs competing amongst themselves to try and guarantee that market share. And I think that both of those at play in this sort of perfect storm of low supply, high demand, and more competition. You put all that together, and unfortunately, we become our own worst enemy sometimes. We can shoot ourselves in the foot, and I think that's, to me, the more obvious explanation for why rebar in particular, and also wire rod, really hasn't kept pace with the price increases in other sectors.
Okay, and you mentioned supply constraints. So do you think that domestic prices could have climbed as high as they have for rebar, even though it hasn't been crazy like with hot rolled coil, but you think they could have reached about, we said 50-something% higher since last year if there were no Section 232 tariffs to have a bunch of import supply? Absolutely not.
Unequivocal, easy answer. Absolutely not. By all accounts, by all reports, by all charts, by all presentations you ever hear, the world still faces a global overcapacity in steel production, or at least capacity. And so there's really, in my mind, there's no rational way to explain the higher prices that we've seen in the US without acknowledging the direct impact of the trade tariffs. I mean, that said, as I just talked about, sure, we have seen higher demand in certain sectors during the pandemic. We've also seen higher scrap prices, even though a lot of flat roll capacity has come offline, as Phil just said. There has been an interesting shift in some areas towards relying more on EAF versus blast, which actually has supplemented or bolstered the scrap prices in America. And you put all this together and you say, well, we should have seen the overcapacity of the world to still have a mitigating effect in the United States, and yet it did not. So to my mind, there's an absolute direct connection that these prices could never have gotten to these levels, but for the fact that the U.S. successfully pushed all the imports out of the marketplace.
Katie, I'll just counter a little bit of what Chris said. I think when you look at rebar prices, they're being driven by a multitude of factors, most notably increasingly higher scrap prices, but also an economy that was much more resilient as it returned from the COVID pandemic than people ever anticipated. You saw a lot of market volatility where demand went to essentially zero because of company closures, because of statewide shutdowns. And then you have the economy coming back out of that, and there's a lot of pent-up demand and a lot of companies that actually were essential during the pandemic, most notably the steel industry supply chain, which did a phenomenal job of operating safely and meeting customer requirements. So when you factor in higher than normal demand that's coming from zero and higher scrap prices, those contributed to the increases as well.
Move on to the next question, directed at Philip. A couple weeks ago, you signed a letter with some other steel associations and labor groups that were urging the Biden administration to maintain the Section 232 tariffs. And the letter stated that while the opponents to the tariffs want to eliminate them in order to increase steel supply in the US, there have been shortages of all sorts of other, there's shortages in other industries too. But imports have historically been a way to keep domestic prices in check. So with US steel producers running at close to 80% now, supply doesn't seem to be as much of a problem right now. It might have been, months ago, but right now it seems to be they're back to normal. So what would be the steel producer argument for continuing to maintain the tariffs even right now?
That's a great question, Katie, and happy to answer it. I think the first thing that you need to look at is when we talk about keeping capacity utilization at above 80%, that has to be over a sustained period of time so that our steel market is operating based on normal fundamentals that we see day in and day out. When you look at the data that's reported by Fast Markets AMM each week, last week, capacity utilization was 81.5%. That was the first time this year that it was over 80%. I'll also add that year-to-date capacity utilization is running in the 78% range. I believe it's 78.1%. And this time last year, capacity utilization was at 69.9%. So we've not seen that sustained level of 80% utilization rates. And also there was a study put out by McKinsey that really said the optimal utilization rate is about 85% versus 80. Also, there's some very important reasons that these tariffs need to stay in place. What they are resulting in is the modernization and electrification of the domestic steel industry. There was a recent report put out by the Economic Policy Institute that shows that there's about $15.7 billion of steel industry investment that's either announced, underway, or near completion. Almost all of these projects are EAF based. And so what that means is that we're going to have a modern steel industry that's producing steel sustainably with a lower CO2 footprint to meet customer requirements. Also, what you're seeing are companies that are making investments in good times or bad, and they're moving ahead with these investments. And then finally, I think it's important to note as we began to negotiate with our allies, most notably the EU, about what comes next. And let's be honest, I think everyone on this call knows that tariffs have a shelf life, but we have to negotiate from a position of strength. For example, in the EU, there's still about 30 million tons of excess steel capacity, and there are a lot of subsidies and state ownerships, not only in the EU, but around the world. So we need these tariffs in place so that we're negotiating from a position of strength. When those talks were announced, there were a lot of people that were jubilant and thought with the stroke of a pen, President Biden would do away with the tariffs. But what you saw was a de-escalation. The retaliatory tariffs in the EU are still in place. The 232 is still in place. And now let's begin the hard work of rolling up our sleeves and discussing what's a viable long-term solution.
Chris, do you have anything else to add to that?
Yeah. There's absolutely no question. Phil's right that, under 232, it has provided the cover that the mills, the domestic mills, needed and asked for to be able to make some significant investments in. I think it's incredibly exciting that we've seen several new projects come online already in the last couple of years. We're seeing more investments, not only just brand new capacity, but certainly increased efficient capacity, and it's turning what was already a first-class production industry into an even more globally first-class type of an industry, much more efficient. So that's an amazingly good thing. However, I will take issue and say that the underlying premise for the argument in favor of the 232s largely had to do with this idea that the mills were unable to get to. They certainly had the capacity to produce more steel, but they were unable to get to those capacities because of the imports. They said we can't make more steel. We had the ability to make more steel, but we can't make it profitably with all these imports. Well, then, you had a bunch of independents that backed that and said, yes, we'll sit at the table with you and argue on behalf and say that that's a very fair argument, and we want to support our domestic producers. And then the tariffs came into place. I don't understand why the mills are still operating at lower capacity when they've successfully been able to keep all of these imports out of the marketplace. For me, it's difficult to understand, the argument for, why we keep the Section 232 in place when you say, well, we have to make sure we have fair trade, that there's unfair trade out there. No question, there are other industries, other countries that may subsidize or otherwise, unfairly benefit their domestic production. But we've had these tariffs for quite a long time, and the mills are still, interestingly, operating at the lower capacity. I don't understand why we didn't see the higher capacity, the more production the United States promised. What we instead saw was what we were explicitly told wouldn't happen, which was that prices wouldn't go up in the United States. Now, so I think, one of the challenges going to be going forward is, as the industry tries to defend maintaining these 232s in place, I suspect it's going to be difficult to find, particularly independent producer or independent fabricators to sit at the table as partners again. And, given that they did it once and now they're bearing the brunt, the producers are getting the huge benefit of the 232, but the consumers of steel are the ones that are bearing the brunt of it.
Just briefly, I think it's important to note that before COVID-19, steel prices had returned to historical norms. I think we need to zoom out a bit and understand that a black swan event like COVID-19 can disrupt markets. It can hurt demand. It can disrupt supply chains. And as we work our way through this, we're going to see the normalization and stabilization of prices. There's about 5 million tons slated to come online in the next year. And by the end of 2023, another 5 million tons of steel that's going to come online. And I got to tell you, our fabricators are an important customer base for steel producers, and we want to work with them. And hopefully we can continue to work with them.
I'll move on to another question. This one also directed at Philip. Also, with that letter that you signed, it was also quoted saying, meanwhile, the tariffs are providing a fairer, more level playing field, creating the market stability needed for companies to invest in the future of the domestic steel industry. I know you're talking about that the pandemic was a black swan event, but the doubling and tripling of certain steel prices, not necessarily rebar and wire rod, but how would that create market stability? Right now does not seem the market is stable whatsoever. And some analysts, like Timna Tanners from Bank of America, is saying that a crash is inevitable.
Well, Katie, Timna has been marketing the Steel-Mageddon scenario now for almost 4 years. And of course, no one could have foreseen COVID-19. And I guess if you just say something long enough, it'll eventually happen. But here's what we need to understand. When we look at a steel market that relies solely on anti-dumping and countervailing duty cases to prevent the surge of unfairly traded imports, you see a market that is still being gamed. And what I mean by that, when you do just trade cases alone, sometimes it takes up to a year to even show damages, and then another 1.5 to 2 years to adjudicate the trade case. So by the time 3 or more years has elapsed, domestic steel producers have lost market share. They've lost control of their pricing. They've often had to idle facilities and lay people off, impacting communities. So the 232 is providing a level of stability. And also keep in mind that there are many companies out there that are working with their supply chains and with their customer base to make sure that they can provide steel in the most cost competitive way possible. And that continues to happen. Also, I will add to close my point is I personally don't think 232 has even been allowed to be as effective as it could have been. If you look at the recent USMCA agreement, Mexico and Canada, our 2 largest steel trading partners, aren't even subject to 232 tariffs. Australia was never subject to 232 tariffs. Argentina, South Korea, and Brazil are subject to quotas, not 232 tariffs. So that grouping alone represents almost 70% of 2020 steel imports. Then add on top of that, Katie, all of the millions and millions of tons of exclusions that were granted by the government. Then late last year, we had general approved exclusions. And then you have companies that receive very favorable court settlements in order to get around paying tariffs. So my summation is that there's plenty of domestically and foreign produced steel available, not subject to tariffs and at a variety of price points.
Well, I can just tell you that from what I hear from many of my ISA Independent Steel Alliance members, as well as other independent fabricators I talk to, so we're just talking about rebar at this point,
Sure.
not the other steel products, but there is a problem of availability of steel. We're not using the word allocation yet. That seems to be a dirty word from the producer's perspective, but we basically are there. The many fabricators are scrambling to find available steel. I get reports somewhat regularly, requests actually somewhat regularly, where some of my members say, look, I'm desperately looking for X, for whatever it is, and I have to put it out to my group. And people are saying, look, I'll take it from anywhere I can get it in the country. I just need it that badly. And so there's not a lot of steel available. It's just a reality out there that there's a real problem. Now, I mean, maybe we've seen, some of the frenzied buying that we saw amongst things like toilet paper during the COVID or something like that. Maybe on the buyer side, people are just panicking and buying, but I don't think that I don't think that it's right to say that there's plenty of steel available, because if there was, then if there was enough steel available, we wouldn't see these prices running up. I think to the higher level question that started this was talking about, are we looking at a potential crash? I certainly don't think there's a crash coming, but we all know that our market is very almost predictably cyclical. It ebbs and flows. This current cycle may have been artificially propped up with, I like that phrase, the black swan event of COVID. But an adjustment is inevitable. It's just a question of when. The thing that I kind of worry about, though, is what signal that we send. We as the entire industry, not just fabricators, not just producers, but as the entire industry, when there is this continued uncertainty, this continued, high levels of ebbing and flowing in pricing. What signal do we send to the specifying community? The engineers, the architects, the owners. Are we sending the signal that our industry our supply chain is vulnerable, that our supply chain is erratic, our supply chain is unreliable? And I think that's actually a bit of an existential question for us to look at as an industry is, are we doing ourselves long-term harm? I've had requests recently from people asking for alternative products because they're just saying, well, look, I can't get certain bar sizes and I've got certain applications. Is there something else I could use? Is something else I can offer? And I don't like to hear that. The last thing I want to hear is people exploring alternatives to reinforced concrete. We want them to be continuing to put steel inside concrete. I don't want them to be looking at fibers and other kinds of design solutions. So, I would applaud and encourage the idea of some kind of stability over the long haul, but there's no question. There's always some cyclicality to our pricing. I don't think it's a crash, but there will be an adjustment at some point.
Here on the competing materials, Chris, I really appreciate you saying that.
Yeah, it's not a problem yet, because some of the things that are being asked for are very, very application specific, which means they won't become widespread. But for probably the last 5-7 years or so, our industry, led mostly through the Concrete Reinforcing Steel Institute, has done an excellent job in sort of watching the development of cross-laminate timber as an alternative to steel structures, and as a threat to reinforced concrete, particularly in low to mid-rise structures. And so, we look at things like that, but now all of a sudden I'm seeing requests for other kinds of products as well. And so it starts ringing bells in my mind that, are we, while we're sort of fighting amongst ourselves for margins versus availability, et cetera, are we actually ignoring the signals that we're sending to the people that specify our products?
That's a good point. You always see a lot of news stories out there, like this is the new steel, like spider silk or
right.
something like that. Like what's going to replace steel next? So that's interesting to keep your eye on that. I have another question for Chris. You've been kind of talking about how the escalating steel prices have affected the fabricator sector so far. Is there anything else you haven't spoken on yet about what the impact has been on fabricators specifically?
Sure. I mean, as you all know, the supply chain works that, the fabricator buys from a mill, but the fabricator has to, and usually buys, and unfortunately buys right now on terms that are basically, you'll get the price when you see your invoice. And that's incredibly difficult for a fabricator who goes to contract, usually on a lump sum or a fixed price basis. So it's incredibly difficult for the fabricators in this particular operating environment. That they know escalations or prices are out there. They know supply is cheap. So they're getting hit on two fronts. One is on the price side, where they've got to figure out how do I cover myself in the pricing, and how is it going to affect my contract. So in this regard, almost every fabricator now is pretty good at including some kind of escalators in their contracts. We learned our lessons from 2004, 2005, again in 08, 09, where we saw big run-ups in prices. And so, almost all fabricators are pretty savvy. And I think to a large extent, contractors are pretty savvy now to accepting them for the most part. But again, as I referenced earlier, all it takes is one rogue actor to say, not just necessarily drop the price, but say, by the way, I'll cover it. I'll guarantee the price for the life of the contract. It just takes one person to do that. And then a contractor says, aha, I don't have to do it. I don't have to accept escalators. So that's one significant challenge that fabricators are facing right now. But interestingly enough, as difficult as rising prices is, from a contractual performance standpoint, fabricators are really challenged right now on the supply side, because it's one thing to guarantee a price, but at the end of the day, they have to guarantee the material is going to show up. And as fabricators are beholden to the construction schedules of their customers, some fabricators are choosing or being forced to either not bid certain jobs at all, or walk away from projects, walk away from bids, because they find out that they're not going to have the steel available to them. And then that just sets up this significant problem where, they're trying to negotiate, how can they deliver the product? And in particular, if there's anything special about the project, if it's a special grade, a special size, an unusual quantity, they have to fit into the rolling schedules of mills. And, the mills can change those schedules, and the mills can or may not make that material available to an independent. And it puts that independent, as I said, in an extremely difficult position. So many independents have been telling me for the last several months that for all intents and purposes, they cannot go after any job of any significant size because the power of the mill and their owned downstream gives that competitor just a significant advantage in being able to guarantee that work. They can guarantee the price and they can guarantee the availability, because with that vertical integration, the mill says, well, my fab shops are going to have all the steel they're going to need, but an independent has to take what's left over. So I would say, it's different that we used to just talk about the challenges to fabricators on the price side. How do you guarantee contractually these prices? But now there's the second element of, can I even perform at whatever price I sell it at? Can I even perform while I have the steel to sell? So it's a very challenging market, very delicate market for independent fabricators right now.
Katie, I'll just add, though, that what Chris is alluding to is becoming a global phenomenon. Over the last several weeks, you've seen increase in prices in rebar in China, in the EU. You've seen increases in lead times. And this is also a function of some other factors, most notably the availability of trucks, rail cars to get products to people. So I would like to, extend an invitation to Chris and the Independent Steel Alliance that we work together on pursuing a manufacturing agenda here in the United States that looks holistically at all of these things that are contributing to these market distortions in prices and delivery times.
Yeah, thank you. Thank you, Phil. One more thing, I'll give an example, actually. It just occurred to me when you talk about global issues. I was talking to somebody just recently in Canada, and we have number 3 bar here in the United States and 10M in Canada. And, it's arguably the most inefficient of all bars for a mill to make, just because to get a single ton, you have to do a lot more handling of it. But there's several mills that have effectively decided and announced, well, we're just not going to roll these bars anymore. We're not going to roll 10M. We're not going to roll number 3. And yet it's still, for particular flat products, like slabs and sidewalks and the like, and pools, it's still pretty heavily demanded product. But now you've got, a very, very significant structural problem in this. Well, sorry, that's a pun. You have a really significant problem that a specific bar that has been used in many instances. I mean, you go in Texas and they use number 3 bar all over the place, rather than wire mesh and sidewalks, for example. And now all of a sudden you've got mills that are just saying, we're not making that bar anymore. And, it's just, it creates yet another challenge of, and again, this doesn't even have to do with competition or pricing. It's just the bar's not available. And so once again, what are we signaling to the specifiers when we say that, we can't have that anymore? They start asking for things like GFRP or fibers or whatever else. So yeah, there are some very legitimate global issues going on out there, and that hit at home with very specific bars, very specific aspects of demand. And yeah, I'd love to. It would be very appropriate if we had as you said, Phil, an holistic approach, not just from the producer's perspective, but look at it from the entire supply chain. Because as you and I have talked about in conferences past, it's the whole supply chain, particularly when you look at all of the downstream consumers that are much more, I think, much more disproportionately affected by these tariffs and these rising prices and demand issues and such, because they're the ones that have to answer to the actual consumers, the ones that are actually building projects.
Okay, go on to the next question. Also for Chris, keeping on the theme of prices. A couple of years ago at our previous Rebar and Wire Rod event, one of our speakers said that one of the effects of Section 232 was to set a definitive floor and ceiling to rebar prices. There was a certain high and low that they weren't ever going to surpass again. But of course, the pandemic has upended everything. Already, the current prices have far surpassed what they said the ceiling would be. So do you think that this current run up in prices is a temporary situation, or do you think that it has shifted the average price range upwards forever? Like, for example, do you think that we'll never see rebar in the $20 range ever again?
Well, first I'm going to start off and say, I sure hope that other speaker you're talking about wasn't me. I don't think it would have been. And assuming it's not, I'm going to say kudos for not having that speaker back again. But interestingly, as Phil said earlier, if you just keep saying the same thing long enough, eventually you're going to be right, I suppose. But no, I do not think that there's, to say that there is a floor, there is a ceiling, and 232 effectively set that. Rebar in my entire career it's a very volatile, relatively speaking, it's a pretty volatile commodity, although typically not over short periods of time. We don't see usually, like what's happening right now, and again, I mentioned 04, 05, and 08, 09, we typically don't see huge spikes up and down. There just tends to be very sort of leveled out ebbs and flows, almost relatively predictable that we have these sort of market adjustments, and these swings play out over a couple, 3 years at a time. Blowing through what we thought would be a price ceiling on rebar, as we've seen recently, blowing through that is probably just a result of myriad factors that we've talked about, this perfect storm of the tariffs together, very high scrap demand, pronounced construction demand, even in a COVID environment, a very, very, very tight labor market. Phil mentioned the trucking and logistics industry and market consolidation. You put all of that together, and all of these forces have now sort of converged, and that's resulted in very, very high prices. I mean, it's very easily explainable in just simple supply and demand economics. The only real constraint, I think, on the ceiling of rebar at this point is actually just the price of rebar is just supply. To some extent, it doesn't matter what you charge for rebar if you don't have it. If it's not available to sell, you can charge $5 billion a ton for it, and you still can't sell it because it's not available. So I'm not sure that there's really actually a ceiling per se. I think the supply itself is the bigger constraint. But then, to your point of, is there a floor? Meaning, are we ever going to go back and see, those kinds of numbers again? I actually really don't want to weigh in on actual numbers, specific pricing, except to say that I do feel like there has been, to some extent, a structural shift, a structural realignment in the marketplace, in the production side of marketplace. I do think that these tariffs are here to stay for a little while. I think they will ebb and flow just as the market itself does. But with the market consolidation we've seen, I think the market is now set up in a way that I find it very difficult to see that even though we will have some kind of market adjustment, that's just inevitable, particularly given that even though the mills may want to, as I said earlier, decouple from directly pricing related to scrap. I think we're now used to that. We're used to seeing that that is the primary input. So even if it's not officially the main driver of price changes, I think that the consumers will see it and will be aware of it. But I don't think that the market, I'm not sure that I think the market will actually allow the prices to get down to those low numbers again. I think that the structural table is set. Meaning when I say structural, I mean the composition of the market is set now, that there's too much benefit in we've seen some of the market, some of the financial reports of some of the producers recently of recent quarters. There's way too much benefit. They're having way too much success for their shareholders. So I find it difficult that even in a coming adjustment in prices that we would see numbers get down anywhere close to those kinds of numbers you're talking about.
Phil, do you have anything to weigh in?
No, I think Chris laid it out pretty well. That's a good analysis.
Okay, I'm kind of going, still speaking about prices too. Or not sort of prices, but what Chris was saying about profits from steel producers. Nucor has a new CEO who's also just elected the chairman of the AISI. And in a statement announcing that, he said that we are the cleanest and most energy efficient of the major steel industries around the world, but we continue to face challenges from massive global overcapacity driven by foreign government trade distorting policies. So this is interesting for the CEO of Nucor to be saying this, that he's facing challenges when that company made almost $1 billion in profits in the first quarter. And import market share has dropped since Section 232. So I'm not sure maybe Philip, you can help me understand what he's talking about of these challenges from overcapacity from his company or other companies of his size. It doesn't seem like they're having many challenges at all.
Well, first of all, the challenge of excess capacity is a global challenge. Katie, the World Steel Association recently reported that there's about 2.5, let me make sure I get this number exactly right. Yeah, 2.5 billion tons of steel making capacity as of the end of 2020. And World Steel, as well as the OECD Steel Committee, have estimated that there's only about 1.7 to 1.8 billion tons of steel consumption slated for the upcoming year. So that leaves between 700 million and 800 million tons of excess steel capacity globally. Guess where that capacity ends up? It ends up in the freest and most open market in the world, and that's the United States. And so for context, the domestic steel market here in America is about 100 million tons. So you have 700 to 800 million with an M tons of excess steel capacity circulating around the globe. And often that steel finds its ways to our shores through dumping, through transshipment, through semi-finished products. And that's what he's referring to. And we have to deal with that. When you do something, let's say hypothetically that President Biden abruptly, with the stroke of a pen, because it was an executive order, did away with 232 tariffs. Think about the market disruption that would cause, the surge in unfairly traded imports, fabricators being caught off guard with high-priced steel in their inventories that they still need to work through while prices drop. So what we really need is an orderly way to deal with this issue of global excess steel capacity. I think it starts with talks at the OECD level. It starts with negotiations between the United States and the EU. But I think that's a very serious issue, and it's kind of the underlying fundamental issue that's driving a lot of the things that we see today. Also, I applaud companies up and down the steel industry supply chain that are doing well because of the decisions they make, the investments they make, and the type of people they hire. And I'd ask Chris, I don't know if your organization tracks any data, but I'm sure you have members, Chris, that are historically having some of their best years ever too.
So I'll throw two anecdotes in. One is, you mentioned earlier about, having sort of expensive inventory. I had a conversation a couple of weeks ago with somebody that was commenting that, early this year when they saw the beginning of prices running up and such, they had a very difficult decision. They said, should we go ahead, just buy a whole bunch of steel and take the risk that we're going to be sitting on an inventory? What if prices go ahead and correct? And they said that, well, he said, look, we're not the smartest people on the planet, but we got really lucky. We bought a bunch of steel, and it turns out the prices maintained to the extent that that they do have expensive inventory, but at least they have it. He said that's the most important thing, is they have something to sell, whereas many others who are very just-in-time oriented are struggling to find anything at all to sell. So that's one point. On the question of, are there people even in fabrication, this very challenged, that I keep arguing is a very challenged segment, are they doing well? I think that there's no question, yes. There are some that have told me, they said, hey, Chris, I'm kind of almost ashamed to admit it, we had our best year ever last year. The ones that are doing well are, and this is true in any market, in any segment that you're in within any market, are the people that make adjustments to the conditions. So, if you're an independent if you're a fabricator and you're used to selling however much steel, let's say you're selling, 30,000 tons a year, and then you set up your business model in this particular market where you say, well, I have to sell 30,000 in order to do what I normally do, you're probably having a struggle right now. But there are other fabricators that said, well, look, this is what the market will allow me to sell. Maybe I can only sell 10,000 tons this year, but the 10,000 I'm going to sell is going to be at a rich profit. And those are the ones that turned around and said, I've adjusted to the marketplace. It was difficult, maybe from an ego perspective to make that adjustment. Maybe from a labor perspective, they don't need as many workers, and that was a difficult thing to lay people off. Independents are usually very family oriented, and they look at their businesses as very, all their employees are like family to them. But nonetheless, you do what you do to survive. And so, yes, there are definitely people, even in independent fabrication, that had good years last year. No question.
And Phil, when you're talking about the overcapacity around the globe, I still, even though there's all this capacity and all this excess steel out there, it's still, you're saying it's coming to the U.S., but it's not right now. It's the tariffs are keeping most things away. And kind of moving on to the next question is that a lot of sources are concerned that if the Section 232, the tariffs were removed, the import market wouldn't bounce back immediately. It wouldn't be an immediate influx of steel, because what's happened in the last few years is a lot of offshore suppliers have kind of recalibrated their businesses and found other markets. And it's not a matter of just all of a sudden coming back and selling to the US. It would have to be an adjustment period. So it wouldn't be an immediate influx of steel that would immediately affect the prices here. I don't know if you agree with that or not.
Well, I actually do agree with you, Katie. That's a very reasonable analysis. You've seen a lot of foreign steel producers adjust their business models, looking more domestically into other regions of the world. And it will take time for import levels of fairly traded steel to build their way back up. But we always have to be very cognizant of the various schemes that exist to get unfairly traded steel into our country, whether that's through transshipment, whether that's through circumvention. Hopefully, as we continue to work through the nuts and bolts of the USMCA agreement, we'll make sure that we have strong provisions with our trading partners in Canada and Mexico to prevent that from happening through their countries. But there are always players out there that can develop ways to get steel to our shores. But yes, you're right. It would not be immediate. I think it would take a while to build back up.
Yeah, I also agree. As much as I disagree with the underlying premises of the tariffs that started the tariffs, and as disruptive as it was to sort of slap those tariffs on, I will at least give the Biden administration some credit for not having a knee-jerk reaction to just rip the Band-Aid off. I think that would have created yet another round of extreme uncertainty, both for the domestic producers and consumers, but also for the foreign producers. They have to look at the market and go, well, wait a minute, is this a temporary thing? Can we start sending steel? Can we start making offers? Are they going to slap some tariffs back on or some other kinds of measures? So, as we all know, uncertainty is never a particularly good thing. But that said, have they adjusted to finding other homes for their products? Yes, they have. Are they angry at the United States for sort of ripping the rug out from under them and taking the market away? Probably, and with probably justifiable feelings. Are they going to begrudgingly return to the United States market? And I say begrudgingly, meaning they're like, are they going to realign again? As long as there is unmet demand, unmet need, then there will some suppliers, some countries of origin will find a way to fill that void. Whether and I agree with Phil that we need to find a way. I think a less blunt tool than tariffs. I think we do need to find a way to address the underlying unfairness in a way that's more fair to the downstream consumers and not just accruing almost exclusively to the benefit of the smaller number of producers. But yeah, it's even if the tariffs start coming off in a small amount, we will start seeing more import steel because there is just a considerable amount of unmet demand in the United States market. And
another one of the associations that's really actually pushing for the tariffs to be removed is the Associated General Contractors of America. They put out press releases all the time about warning about contracts are being canceled or delayed or postponed. And they're saying that getting rid of the tariffs would give a needed boost for key construction materials like rebar. Have you heard anything from Chris from your suppliers, since they're working directly with construction companies? Have they noticed that there's been a bunch of contracts being canceled? Is there a trend that they're starting to see where the high prices are starting to actually affect demand at the very bottom of the end use level?
So Phil mentioned earlier on that there's been a lot of, you could argue that a good amount of the work that was done last year and construction didn't seemingly stop last year, but it was work that was pretty much already in the pipeline. It was already committed. It was already, on the books. I don't think that we're seeing so much projects being canceled right now, but I think the combination of extremely high prices and the uncertainty of supply, what you're seeing instead is a lot of projects just not going forward. They're not canceling. They're just saying, well, we don't need to do it right now. Let's wait. I think the entire industry knows that some way, shape, or form, there will be adjustments, and they'll get what they think is a correction back to some sense of normalcy, some sense of predictability. And again, I don't think it's as much about pricing anymore as it is about supply. About if they're going to start their project, then they need to know that they could actually get done on their project, get working on their project. So, I think one of the challenges, with respect to the removing of these tariffs and then what effects they would have down the road is, an analogy I kind of thought about the other day was, have we in effect created a dependency? And Phil, I'd be interested in your kind of thoughts on this. To what extent has our industry become dependent on these tariffs, dependent upon the protection of tariffs? And it's like a dole system in a sense for workers, where we argue now that there's a lot of laborers that don't want to come back into the workplace because they're basically being paid not to work. I think there are a lot of other factors, but for the producers themselves, how are they now in effect a little bit dependent? Has tariffs become the new opioids of the steel industry?
Appreciate the very elegant speech there, Chris. The answer to that is no. And the reason is the American steel market is the most competitive steel market in the world. And the reason for that is it's over 70% EAF based. So here you have sustainable, low CO2 producing steel companies with entrepreneurial spirits that are ready to compete in any market as long as the playing field is level. The tariffs recently celebrated their 3-year anniversary. And I think they're important that they remain in place while we negotiate with our allies and while we continue to see this over 15 billion tons of investment come online. These are not companies that just rested on their laurels when the tariffs went into effect. They continue to hire people, they continue to invest. Very few of them even laid off workers or idled their facilities. So it's not an opioid at all. Our steel companies, particularly the members of the SMA, can compete with anyone in the world. I think it's also important to understand that a lot of construction projects are being reevaluated, put on hold, or canceled, not so much exclusively because of prices and availability, but because of the changing landscape and the way we live our lives that was a result of COVID-19. People are not commuting into downtown work centers anymore. So there's not the need for office space. People are shopping online more. So there's not the need for shopping malls, but there is the need for warehouses and distribution centers. Because people can literally work anywhere, Chris, folks are deciding, hey, I don't want to live in Silicon Valley or New York or Massachusetts. I want to go to Florida or Texas, where the weather is better. There's no state income tax. And thus you see very robust housing markets. So I think you need to factor that into account as well.
Well, this is no knock on Texas, but I'm not sure I would say Texas has better weather. But I do understand your point. And yeah, I actually just over the weekend had some conversations with an executive at Jones Lang LaSalle, and we were specifically talking about the challenge. As we all know, we've seen reports that so much of the construction that's gone up in the last year has focused in sectors that we don't normally see big spikes, and residential being the key one. And I think it directly reflects, Phil, what you're talking about. There is a changing landscape. More people want to live outside of the big cities, but still be reasonably close. There's been a lot of development in around beach communities, mountain communities, lake communities, where people can basically work remotely and such. And so that, raises a huge challenge for, a company like JLL and many others like them that basically are in the business of managing, office spaces, that you've got tons of tenants now coming back and saying, sure, I'll re-up my lease, but I only want half the space. And so that trickles down to our industry that, well, what does that mean? Are we actually, given that we saw office construction drop by about 11 or 12% year over year, are we going to see that rebound? I don't think there's any question it's not going to rebound, because we're going to have to go through a period of figuring out what to do with all the excess inventory. Usually when people are booking new office space, they kind of want something new and nice and shiny, but there's going to be all these deals available. But so from us, as those who want to build buildings, as opposed to go in and remodel those spaces that are there, reconfigure them for more cubicles and remote workers coming in and out and such, we want to build new things. And I think that's going to be an interesting challenge for that particular segment going forward.
Yeah, I agree too. I don't think that office space demand is going to ever be as high as it was pre-pandemic. I kind of predicted this when it was all going down last year, that a lot of people that were forced to work from home, a lot of industries that were forced to work from home, will have realized that they don't actually need to be paying all the overhead costs for an office space, if their workers are capable of, still being productive either at home or wherever they're working remotely. So I do think that something's going to have to be done with all the existing commercial spaces before even new commercial spaces can be built. So it'll be interesting to see what happens with that going forward. Kind of shifting over to more with building, but with infrastructure. There's infrastructure bills currently being negotiated in Congress right now. Hopefully we'll see something this year. It will increase demand for steel no matter what. Do you think that it will keep prices, will that be a factor that will keep prices high, do you think? Or will there be a corresponding increase in capacity utilization that will balance that out?
All right, sure. A lot of times we talk in the industry that, these artificial prices. And I just do want to say that I don't think there's anything artificial about where we are right now. I mean, as we've already talked about a couple of times, there are very real world supply and demand reasons why pricing is what it is right now. So while some of those issues we can address them, especially on the supply side, I do think there's, we're seeing the pricing levels that we're seeing because of legitimate surges in demand and legitimate issues of supply. I think sometime last week, or maybe Tuesday or Wednesday, the Census Bureau reported that the seasonal adjusted construction spending year over year was up by like about 6%. And as we just talked about, residential jumped, double digits, but, non-residential residential jumped, but non-residential has actually come back by almost 10%. So we're seeing, these trends going on right now that are affecting and seemingly supporting this narrative that these prices are all trending up. Are we going to see the mills ramping up to do more? I think that's, again, the argument I keep making. As Phil, as you've said, the mills are successfully now getting to 80-81% cap utilization, but we're still seeing, as I think again, sometime last week, the AGC's chief economist, Ken Simonson, he reported that, there are still supply chain delays across nearly every single segment of steel, whether it's, bar joists, decking, studs, of course, rebar and wire mesh. And it's expected that that could delay out all the way into, Q1 2022. So just like a lot of people as individual consumers where, you try and order things like a refrigerator right now, and they'll tell you, oh, you might get it by, December or January. I think we're seeing those same kinds of comments being made in our business. And so in our industry, so, although I have not seen any recent evidence to show that the mills, would voluntarily increase mill utilization, capital mill utilization, especially with products like rebar. Again, there's that extremely rational decision to put that capacity elsewhere, but it is a fixed capacity. And so in our little segment, in my little segment of the industry, ours, as most of us on this group, whether it's rebar or wire rod, we would love to see more domestic rebar made right now. But, when I talk to mills, whether it's, one of the large mills with downstream or an independent producing mill, and they say, look, we're just making a lot more money on other products. I can't argue that. It's what their shareholders want. It's what they should do. But, when you, again, not to repeat it, but when you keep having issues of availability, scrap pricing, trucking, et cetera, all that combined, it's difficult. It's a difficult market environment for a fabricator, for a consumer of the steel to be able to, to argue some consistency and reliability in their ability to perform in the market right now.
Well, Katie, I'll jump in and say that there are companies that are committed to increasing their rebar making capacity. You just need to look at the recent announcements from companies like Commercial Metals with their facility in Mesa, Arizona. When you look at the CapEx investments that are planned by Optimus Steel in Beaumont, Texas. Nucor has just started 2 rebar mills, one in Sedalia, Missouri, another in Frostproof, Florida. And I might add that most of these mills are also employing renewable energy like solar and wind to help make that rebar more sustainable. So there are companies that are committed to doing this. I think the big answer to your question depends on what kind of infrastructure package we get. There have been a lot of numbers thrown around here, some as high as $4 trillion. But at the SMA, we really want our infrastructure investment program to focus on steel-intensive, traditional infrastructure. These are roads, bridges, airports, seaports, our energy grid, rural broadband, things that really help the wheels of commerce turn. And then we also want people to understand that if the steel that is purchased for that infrastructure is made for Americans by Americans, it'll be the greenest, most sustainable steel that they'll ever buy. And so it will not only build back better our infrastructure, it'll help improve our environment. We think, and there was a study done by City Research, that a $1 trillion infrastructure package has the potential to increase incremental steel demand by about 6 million tons per year over the next 5 years. And let's be honest, a $800 billion to $1 trillion infrastructure package is a big deal. And that's something we could definitely support. And I know some of the social infrastructure initiatives supported by the Biden administration are important, but now is not the time for that. What we've got to do is build our nation's critical infrastructure back better.
Okay. Well, I think that whatever bill they end up finalizing, the traditional infrastructure, the roads and bridges, that's going to be the foundation of it, no matter what, and anything else will kind of be supporting those efforts. So is the SMA involved currently or planning to be involved in lobbying for the bill to pass, whatever version they end up negotiating with?
Yeah, absolutely, Katie. The SMA and its member companies have individually and collectively lobbied in support of a long-term, well-funded, comprehensive infrastructure program. Also, the SMA is part of several coalitions, the Steel Industry Coalition, the Metals Industry Coalition, which you'll be happy to know, Chris, includes a lot of fabricators, work very closely with Ed Udell in lobbying for this. We've also joined on to letters by the U.S. Chamber and ARTBA as well. So yeah, this is very important to our members, and we're going to work hard to get there. I know right now it seems like it's an uphill battle and some people are getting pessimistic. but I've actually been more optimistic than I've been for years that we're going to get a good infrastructure package passed.
I think that there's no question that we will eventually have an infrastructure package. Again, whether it's going to be 4 trillion or 1 trillion or whatever, it's still relatively speaking to our overall need. It's a drop in the bucket, but it's a drop that needs to happen. I will differ a little bit with this idea that it needs to be just traditional. I think that just as we were talking about earlier, that the workplace has changed. It has fundamentally changed how we work, where we work, et cetera. I think it's very legitimate to say that, our view of what is infrastructure changes as well. To talk about, Wi-Fi, for example, broadband capabilities, as the workforce has changed, as the workforce, the workplace has gone much more remote, we need to acknowledge that, we need to be able to enable that in America. We need, significant investments in technological infrastructure. Look at what's happening right now with, ransomware and we need security amongst our IT infrastructure in America. That may not be looked at as traditional infrastructure, but at the end of the day, it ultimately enables us to continue building, to justify building more roads and bridges. Because think about it, as more people work at home, they're still ordering more things. They're ordering stuff to be delivered to them across these roads and bridges. And so we're going to need more distribution centers, maybe not as large, but more of them in lots more areas. So that's just one little example. So ultimately, we do need, we obviously need to keep building roads and bridges and other, water treatment and other kinds of infrastructure. But I do think that it's appropriate to have a little bit of a broader definition of what 21st century infrastructure really means. And if we really want to, as a country, to continue to be a global leader in so many of these areas, then we need to make the kind of investments that we're unfortunately seeing being made by China and other countries, other of our major competitors. And we will make them eventually. I'm very confident we will. We just, in this extremely politicized and partisan environment, I think that we just have to get through the nuts and bolts. But eventually we'll get there, because as we know, bricks and concrete and steel is very, very attractive for any constituent and any representative.
I agree. And also, if an infrastructure bill is passed, that might be a good time to remove the Section 232 tariffs, only because the Buy America restrictions are going to make it so only domestic steel can fulfill the infrastructure needs. And there's going to be a lot of other needs that, is that going to make supply even more constrained than it already is? It might be a good idea to let a few more imports in at that point, just to offer some supply to the non-infrastructure things.
Well, one thing to note, Katie, is that domestic procurement preferences do a couple of things. First of all, they give American manufacturers first crack at supplying the steel and other materials that are necessary to build back better and to have a comprehensive infrastructure investment program. But the most important thing they do, and it's often underreported, is that domestic procurement preferences also make sure that the most sustainable steel in the world is being used. You do not want high carbon emitting steel that's produced in places like China being shipped across oceans, which also adds to the amount of CO2 emissions due to their transport, and also the mining and extraction of raw materials that are used to make those materials. So there's a dual benefit of domestic procurement preferences. It has to do with sustainability, and then it's to do with the fact that it's creating jobs here in America and not abroad.
Right.
Yeah, I'll jump in. There's absolutely zero contention, no question at all that, a dollar that we spend locally, domestically, generates $5 to $7 of economic return. So to the extent that we can, that's been shown, studies for years and years and years. It's an oft-quoted statistic. So I absolutely have no problems with, these domestic buy provisions. But the problem we face is that if there's just simply not enough steel right now, that if we do have an infrastructure bill, there's going to be a significant problem of, well, great, we have a bill and we got all this money, but we can't supply it. And even, and then there's going to be even this more demand, more pressure actually from the politicians that signed this bill to say, well, we need to build these roads and bridges. I promised my constituents we were going to do this. which is going to divert available capacity, available production to steel. That means we can't build the schools and the offices and the Lowe's and Home Depots and the other kinds of buildings that infrastructure will spur the demand for. And so, I do feel like at some point the dam will break, and the dam being the demand for more steel. And we're going to have, particularly when we add an infrastructure bill, we're going to need to have some more steel available. Now, if that means, I don't think it should be done with just carving out more exceptions, that creates an even more Swiss cheese type effect that Phil was referring to earlier, with all those exceptions that went put in 232. But there will need to be more steel, because as I said before, it doesn't matter what you sell it for if you don't have it to sell.
Kind of also talking about the effect of the pandemic on the steel industry, more on the business side. This question is more for Philip. How has the steel industry on the production side recovered from pandemic shutdowns? Is it full recovery at this point? Employment-wise, have mills recalled most of their furloughed or laid off workers? How is it going on the mill side as far as recovery?
I think it's going much better than we ever anticipated, Katie. And I want to applaud the U.S. Steel producers and the domestic steel industry as a whole for their role as essential industries, helping to meet customer demands while keeping their employees safe and the communities where they're operating safe. Most SMA members kept chugging along. They never laid anyone off. They never idled any facilities in any really large way. And they're doing a very good job of reintegrating their non-production personnel back into the fold, with many companies announcing return to work programs starting this summer to get salespeople, marketing people, HR and administrative people back to the facilities and to the corporate offices. So I think that they've done a tremendous job. Keep in mind, this is an industry that has always, put a premium on safety. This is an industry that has always put a premium on technology as well. And what you're seeing is many of them deploying things that help make remote work easier, but also work in the mills easier, whether that's artificial intelligence with companies like Big River Steel, an SMA member leading the way, robotics, or just state-of-the-art production in areas everywhere from their continuous casting to their EAFs to the value offering they offer the customers. So overall, I think domestic steel producers have done a great job here.
Okay. Chris, how about on the fabricator side? How's the recovery from fabricators been going?
Yeah, I think for the most part, most fabricators, again, most all businesses have figured out how to operate in this environment, and they've made their adjustments. I think that going forward, labor, I think, is clearly one of the most significant issues right now. We've talked, ad nauseum now about supply and pricing, but I think labor is really a significant issue. There's been so many reports of coming out of the pandemic, that a lot of workers don't want to come back, because of, the federal benefits they're receiving. There's some truth to that, but I think there's also a lot of other issues that are kind of factoring in on this. I think, whether it's on the production side in the mills or even in fabrication shops to some extent, as our industry itself evolves and continues to become more high-tech focused, Phil, you just mentioned it at Big River, all the AI and other companies are using robotics and such. Although that kind of tech hasn't really trickled down into the fabrication sector yet, it's probably coming at some point, but it's not there right now. But overall, as our industry, even as we're asking, as a fabrication company, as we're asking workers to, particularly the engineering side, the detailers, the estimators, and others to work remotely, we are still asking them to interact in a more technologically advanced way. And one of the challenges we have is, particularly in fabrication, that the average age of worker can be a little bit particularly on the higher skilled side, can be a trend on the higher side. And so we end up creating this skills gap based on technology. And I know it's happening in the mill side as well, where we're asking, we say we need workers to come back in, but they don't have the skills required for these new high-tech production facilities, and even to some extent, some of the higher tech demands in fabrication. And so that's creating a real problem. And, those same workers that I'm just talking about, the ones that tend to be a little bit higher of age, they're reaching retirement age. And from a fabrication perspective, it's extremely difficult to replace that person. You're asking, it's hard enough for a publicly traded mill to justify bringing somebody on who doesn't have the skills to say, well, I'm going to have to invest 12 to 18 months to train them up, while simultaneously, in parallel, having somebody employed who can do that skill today. On a fabricator's perspective, who don't have really the resources to do that to a large extent, it's very difficult to bring somebody in and train them up. The requirements they're facing now. Probably a final factor I would throw in is that, it's for better or for worse, the pandemic created an environment where a lot of companies and then a lot of individuals too, had to readjust. It was like a giant global experiment where we had to sit back and rethink a lot of things, how we do things. But I think on the labor perspective, why we do things is a problem. And, our industry is, it's not the prettiest, particularly a fab shop. It can be, particular workers out in the fab shop, it can be a very dirty and a hot day. And unfortunately, I think a lot of fabricators are facing that, they're trying to bring some of these workers back. And, the argument is, well, I'm coming back to do bad work for bad pay. And, because it's a highly competitive, situation. And so, they can't pay a lot of money, or what they think is, what the workers may think is not a lot of money. And some of these workers have now had enough time off to figure out some other way to make ends meet, whether it's become a social influencer or whatever else they figured out. They figured out how to make ends meet. Now, that may be in conjunction with the federal subsidies they're receiving. So only time will tell, are they going to get hungry again and have to come back? But it nonetheless is creating a really significant challenge for fabricators to sort of ramp back up to the new normal of today, to get back up to where they were in terms of production and the staffing levels and such. And I really do view labor as being one of the biggest challenges going forward in our segment of the industry.
I'll just add to what Chris said. I think it's also important from a policy perspective. The Biden administration does not water down or diminish the role that industry-sponsored apprenticeship programs play. Not all apprenticeship programs are government-based or organized labor-based. There's many very successful private-based apprenticeship programs that need the support of the government. SMA member Nucor has taken matters into its own hands at its Tuscaloosa, Alabama Academy, where they train instrument and electrical techs. And when you're done with that program, you'll not only have an associate's degree, but you'll have a job waiting on you at a Nucor mill. And I think that we need to see more of that, and the government needs to support it.
Well, maybe you can, when you're talking to your friends at Nucor, you can ask them if they would be interested in starting programs like that, not just their own mills, but maybe for downstream steel industries and fabricators as well. So training these people and investing in the apprenticeship, even though the person isn't going to be working as a Nucor employee, maybe working at a fabricator nearby or something. Maybe that's something that they could do to support the overall industry, not just their side of it.
I'll say I wouldn't hold my breath on that. And I don't mean this about Nucor, but I mean about I really seriously don't mean it about Nucor. Nucor's an amazing company. But I mean, why would, in a free market society, why would any company want to support their competition? And that's been an argument that, particularly the dynamic in my industry, the independents relative to, I won't say versus, but relative to the mill supported competition. There's been within our industry talk for years and years about, collaborative agreements or arrangements where we could do training programs, whether it's to train engineering side detailers and estimators, or some work standards for how a bender operates in an environment with certain pieces of equipment and such. But the challenge at the end of the day always comes down to, when you ask company A, do you want to pay for this? Knowing that it's going to go to the benefit of their competition, it's a very reasonable thing to say, well, why would I do that? We do these programs for our own companies. But then further, from a fabricator's perspective, when they make this investment, when they, one of the challenges they face is they say, look, I do make this investment to train people up. It takes us a lot of time and a lot of resources. And then one of the much larger companies swoops in and hires them in a number that the fabricators simply can't compete with. And so it's very difficult that, for a fabricator, an independence perspective, to compete against the resources of, publicly traded companies. And we don't have a solution for it yet. We certainly would welcome discussions about it, but yeah, I can't begrudge any company saying, why would I want to help my competition? I wish they would, but why would they?
Well, that's true. They could also maybe not work where how Nucor has its own facility to train them, working with technical schools or community colleges or something along those lines to make a major investment. I'm going to, name the Nucor School of Fabricating or something, where they will get some of the employees, maybe not all of them. So yes, they're, I guess, kind of helping out their competitors too, but they're mainly helping the entire steel industry, because if there's no more skilled fabricators, then the fabrication companies can't buy the steel, and then who's buying the steel from the mill? So I think it's still maybe a worthwhile idea to explore for Nucor, who can definitely afford it.
Commercial Metals did something similar. I'm sorry, Chris. CMC did something similar. They made a major investment in the metallurgy program, the steelmaking program at Texas State University in San Marcos, Texas. Yeah, along those lines.
An interesting development, and I think this is years down the road, but just has happened in the production of steel, where you have labor issues and global competition issues. And so you innovate and you figure out ways to become super efficient. Usually that involves some degree of automation. I think that, even again, from my perspective as a fabricator for 20 years and working with them now for an additional 10 years, we kind of have this reaction and say, oh, you could never automate the fabrication of rebar. Well, I think you can eventually. I think eventually it's going to happen. And there's a company in New York that's actually working on, we already have equipment that can sort of semi-automate, instead of a process of putting, say, three men on a shake table and a bender and a cast off. Now you can operate it with one individual sitting there, but it still requires somebody. But there's a company in New York that's working on an actual robotic facility that can just fabricate rebar. And fascinating. I think it's extremely rudimentary at this point, but nonetheless, when there's a problem in labor, a sustained problem in labor, generally speaking, somebody will innovate around it, and it's going to involve automation. So, maybe it's 10 years down the road, but it's probably coming at some point. And maybe we'll be having a discussion. Why are there only half as many in fabrication now, and yet we're much more productive? It's because we automated.
Right, and that's happened throughout the entire history of the steel industry, correct?
Yeah. Yep.
All right. For the last question, for both of you. What do you miss most about in-person steel conferences? You can start with you, Philip.
Sure. Yeah, Katie, for me, I'm kind of an old school guy. So I like shaking hands. I like looking people in the eye, patting them on the back, having a drink at the bar, to share ideas, to understand what is going on out in the marketplace, to understand what companies' needs are. So that's what I miss most. And I think we're going to gradually get back to in-person meetings. I know that in November of this year, the SMA will have its annual members conference in person. Now, albeit it's a smaller meeting, probably 100 to 150 people, we think it's time. And hopefully over time, our member companies will lift their travel restrictions, and we'll start meeting with our rank and file members through our SMA committees as we go into 2022. But definitely the networking and connection is what I miss the most.
Yeah, there's nothing like face-to-face meetings. Even amongst my group in the Independent Steel Alliance, with our fabricators and our suppliers, there is an extremely high level of pent-up demand for getting back together, for working, in these, ad hoc, unscheduled kind of get-togethers, these little one-off meetings. I really appreciate that even in this virtual platform, you guys have facilitated to some extent the ability to kind of jump off and have a little one-off networking session and such. But there's no question with the veil between us, this virtual veil, it's a little bit less. It's a little bit less effective. So the ability for us to get back together, to meet in person, I think there is a huge pent-up demand for people coming back together. We're seeing it. We're scheduling our annual shareholders meeting for October of this year, and I tell you, it was difficult to find the find the space, because everybody and their brother is scheduling conferences for fall, because I think most people are assuming that by then, most of the restrictions will be lifted. People will be able to travel, and there's going to be a huge demand for getting back together and you know, slapping people on the back, shaking hands, and spilling a drink on each other.
Sounds good. Okay, we're going to do another poll before we get to the audience Q&A. So I'm going to head over to the poll page for everyone who wants to join me. So we'll start the poll. The question for this time is, rising steel prices will start to decline in either third quarter, fourth quarter, or not until 2022. So everyone can put in their answers. I'll give you a few seconds. So far, it seems most respondents are saying not until 2022, but we'll give a few more seconds. They're still responding. 2022 is still the top percentage so far. Okay, well, let's go ahead and end the poll. And let's see. So we have 60% for not until 2022. 35% say that prices will start declining in the fourth quarter of this year, and only 5% think that it'll start declining in the third quarter of this year. So maybe some of you can use that information for your benefit. Okay, let's go on to some audience questions. Let's see. It was funny, someone sent a question while you guys were talking about allocation. Less than 80% utilization is happening right now, yet mills are putting customers on allocation. It seems like a shortage of capacity. Either one of you want to respond to that?
Well, I just will say that there's capacity that is coming online as we speak, and there's more that's going to come online in 2022 and 2023. It's across all product segments: flat rolled, long products, structural. Also, when we see this capacity come online, most analysts predict that you'll see a stabilization in pricing, stabilization in lead times. And we should commend domestic steelmakers for moving forward with this type of CapEx investment in the midst of a pandemic. So we're definitely going to get there. Also, you got to look at capacity not so much as an addition problem, Katie, but more of an algebraic problem. When new capacity comes online, it's not totally additive. It's often displacing inefficient capacity, both EAF and integrated. It's displacing imports, as we've been discussing for the last hour or so. And it's also opening up new product segments. And it's requiring companies to rethink how they use their production portfolios. Do they change their product mix? Do they idle all of it? Do they idle a portion of it? So this is a lot more fluid situation than people sometimes realize, but I will definitely say help is on the way.
Yeah, I mean, the A word, allocation. That's the big fear for all of the independent fabricators is being told or even hinted that they're going to have to face allocations. But again, as I agree with what Phil said, there's whether it's all of the brand new capacity that's been built in the last couple of years and continuing to come online, and then whether or not we have a release of 232 and we have more steel coming in some way, shape, or form. The problem will solve itself eventually. It's just, I think there's still a little bit of short-term pain to have to be endured.
Okay. Move on to another question directed at Philip. Philip was talking about the modernization of the U.S. steel industry and $15.7 billion in investment, which is happening because of the tariffs. But a lot of these planned expansions were in the works before Section 232 was announced, and it seems like you're using this as an argument in favor of 232. So how is this an argument in favor of 232 since the expansions were planned before the tariffs were announced?
No, great question. And anytime that you're dealing with building a greenfield steel mill or billions of dollars of investment, that takes months and years of planning. So these investments aren't exclusively a result of the 232 tariffs. These are things that have been contemplated or even started prior to the tariffs. But what the tariffs do allow to happen is it creates a stable market environment so that companies can go steam ahead with these projects and not delay them, not cancel them, not scale them back. And I think that's very important to note. Also, companies want to invest in good times or bad times so that they can seize market opportunities and expand their product offerings and delve into advanced, high-strength, next-generation steels. And that's what you're seeing here. You're seeing mills that are really being developed with state-of-the-art process equipment, a focus on sustainability, low spins.
Well, to sort of, I guess, play on the dynamic of, or comment on the dynamic of the mill-owned fabs versus independent fabs. Again, I keep harping on that, but it's my bailiwick. Sure, we have a lot more capacity coming online, and yes, it's much more sustainable, it's much more green, it's much more efficient, et cetera. But those same big two mills now control an even more concentrated amount of downstream fabrication. And with both of them effectively posturing that their shops come first in terms of who gets access to that steel, it just creates a more difficult position going forward, where a lot of independents have effectively had to align themselves, had to pick one, at their own peril. If they don't effectively fly a banner of one of these mills, then they are cut out, so to speak. I don't mean to imply there's an official cutout, but it means they're not going to be favored, and this is a reality that they have to face. We faced it for a long time when there was a big three. Now more sort of tightened two. It's an even stronger dynamic. So I think the independents are a little bit wary of where all this new capacity is going to be leveraged. Are they going to participate in it, or are they going to be cut out of it?
Another question is from Don Lewis. He asks, when the Biden administration passes the infrastructure bill, how is that going to impact the shortage we're already seeing in the marketplace? Our already are seeing lead times on wire mesh at 3 months, and domestic rebar has recently shipped out to about 2 months on new orders.
I'll on that. I've had several conversations with both mills and fabricators that have corroborated the same story, that to a large extent, as a fabricator, if you're not already ahead 2, 3, 4 rollings, you're already gone, you're out. I know at least domestic producers already committed, for all intents and purposes, their rollings are committed for the rest of the year. And so it's a difficult thing for a fabricator, for the consumer deal, to be able to with accuracy what bars they need that far in advance, because they don't exactly know which jobs are going to go out and at what timetable. So it's difficult to deal with these lead times, but I guess the only saving grace for the fabricators is that they are able to communicate this problem to their customers and say, hey, not that I'm going to go ahead and preemptively cite force majeure, but I'm going to tell you that I think I'm going to have the steel, but we'll see when the time comes.
And Katie, I think what we want to see is increased capacity come online. And as I had mentioned earlier, the 232 tariffs celebrated their 3-year anniversary. We are confident that when things stabilize, there will be a normal market consisting of domestically produced steel, fairly imported foreign steel, that should make this available. Make products available so that we can deal with the increased demand that the infrastructure package will bring.
And then the last question from an audience member I have, since the 2 tariffs are in place and from coming into the country, wouldn't it make sense to limit the amount of scrap steel we export so the mills can compete price-wise and not be subject to supply deficiencies?
I'll start with that. There is some concern that limiting scrap exports is not WTO compliant. Keep in mind the 232 tariffs have been upheld by the United States Supreme Court. Although there's no real evidence of unfair trade practices in terms of scrap, dumping, subsidies. That doesn't exist in those markets. So we'd like to see a free and open market, a flow of scrap for markets. Keep in mind, a lot of domestic producers do import scrap from foreign countries, particularly high quality prime scrap, most notably from the EU. So, you know, we want these markets to remain as open as possible.
You know, we had a conversation, I think, a couple of cycles ago here at RWR, where we actually talked about on the panel the idea of, you know, given that scrap is sort of the number one input, and we, at least at present, we in America are basically producers of scrap in the world, so everybody wants and needs our scrap. You know, instead of putting tariffs on the products coming inbound, and I agree, if we were to just limit the scrap, then create an artificial market in a sense. But if instead we said, look, if the whole world scrap and we need the scrap as well, you know, I've, like you said, Phil, I've never heard any allegations that there's any unfair trade practices with the scrap. But the problem is that if the domestic scrap producers are getting offers to buy scrap that are at higher prices than the domestics were paying, let's say yesterday, then why wouldn't they sell it overseas? And then that creates a supply issue internally. So the price that drives the price up. So it seems to me, and this is something that we talked about a couple of years ago, is maybe an interesting approach should be somebody should study what would be the effects of actually having some kind of an outbound tariff on scrap to basically protect the supply for the domestic producers, the one key product that they need the most, make sure that we have enough of it and it's not disappearing from our own shores.
Well, I don't have any more questions from the audience, so we can wrap this up. I'm going to thank you, Chris and Philip, again for joining us. Your insights are always very welcome. So I'm going to go ahead and click on to, you guys can wave goodbye.
Thank you very much, everyone.
Yeah, thank you, Katie. I enjoyed it.
And Phil, thank you for your comments. I always enjoy seeing with you and talking with you.
Yeah, absolutely. Much respect, my brother.
Okay, trying to do my screen share here. And I want to thank everyone else for attending, and hope you find some useful insights to use. And to let everyone know the networking remains open. I'm trying to figure out how to, oh, there we go. Sorry, I'm having some technical issues with sharing my screen here. But the networking will actually remain open through tomorrow. So if you want to go ahead and, I can't do it. Sorry about that. So yeah, so the networking is still open. Hopefully we can see everyone in person next year at the next year's Rebar and Wire Rod. I'm not sure when it will be. It's kind of up to World of Concrete whether they're going to do their normal expo on in January, February, like as usual. But other than that, hope everyone has a great rest of your 2021, and please take advantage of our networking opportunities. All right, thank you very much, everybody, and I'll see you next year.